Ladies and gentlemen, good day and welcome to the Go Fashion India Limited Q2 and H1 FY'25 earnings conference call. This conference may contain forward-looking statements about the company which are based on beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gautam Saraogi, CEO of Go Fashion India Limited. Thank you and over to you, sir.
Yeah, thank you. Good evening and a warm welcome to everyone present on the call. I have along with me Mr. R. Mohan, our Chief Financial Officer and FGR Investor Relations Advisor. I hope you have all received the investor deck by now. For those who have not, you can view them on the stock exchange and the company website. I'm happy to share that we have successfully sustained our growth momentum despite the ongoing challenges in the apparel retail sector. In H1 FY'25, our revenue reached 429 crores, a growth of 13% on a YOY basis. Our EBITDA stood at rupees 136 crores, a growth of 12%, despite a softer demand environment. Our EBITDA margins have roughly stayed in line and stood at 32%. This is due to the improved product mix and high focus on maintaining operational and cost efficiency. Our full price sales accounted for 95% with an average selling price of 759 for H1. Unfortunately, we made an error in the investor presentation. We have mentioned at 742. 742 is actually the average selling price for quarter 2. For full H1, the average selling price is 759. In a challenging demand environment, this underscores strong customer loyalty and acceptance of our product and its pricing. Our brand's ability to not only rely on discounting sets us apart from our peers. Our unique product offering combined with quality and competitive pricing positions us favorably in the industry. As demand begins to normalize, we expect the mass premium segment to lead in terms of growth. From our internal study this quarter, we discovered an important insight which indicated that sales were shifting from the smaller stores to the larger stores as the very small stores cannot accommodate a full collection. In response, we made a strategic decision to not renew the leases of these very small stores, due to which we have closed 13 stores. In these 13 stores, about 9 to 10 stores are pertaining to these very, very small stores, which are probably lower than 200 square feet. Over the past next 2 quarters, we see ourselves closing 15 to 20 stores of this manner. We are confident that sales from the smaller stores will transition to a larger stores in line with this approach. In H1 FY'25, we opened 54 stores, new stores on a gross basis, and on a full year basis, on a full 6 months H1, we opened 41 stores at a net level. On a full year basis, we aim to open at 120 to 150 stores on a gross level and look to open about 100 stores at a net level. Our A&P spend as a percentage stood at 2%, which is in line with our previous commentary. Coming to working capital and cash flows, we at Go Fashion strongly believe in sustainable growth backed by cash flows. Against the backdrop, we achieved a strong pre-Ind AS operating cash flow of 55 crores in September 2024. This is due to strong focus on inventory and supply chain efficiency. Going forward, we aim to convert more than 50% of our EBITDA into pre-Ind AS operating cash flows. On the inventory front, we have maintained a focus on efficient inventory management, which has led to a further reduction in our warehouse inventory level. As a result, our inventory days have decreased from 104 days in March 2024 to 97 days in September 2024, showing a 17 days reduction. As we approach the festive season, we are witnessing encouraging improvements in footfall across our Go Color stores, fueled by improving customer sentiment. We, with our wide selection of bottom wear, we are confident in our ability to capitalize the momentum and anticipate a strong recovery in SSSG and improvement in our P&L hygiene. On way forward, our first step is to achieve low single-digit SSSG, forward which we are on track towards. Secondly, we would grow our footprint by increasing the number of stores in our portfolio. Lastly, we continue to focus on inventory optimization, where it can be done to further improve our balance sheet. We expect our inventory to remain in the range of 90 to 95 days by March 2024. To conclude, although retail demand in India is currently looking subdued, we expect it to pick up in the coming months. Several factors support in this outlook, including the festive season ahead, which typically boosts consumer spending, a gradual recovery in economic conditions, and a return to social events and weddings. Additionally, improving consumer sentiments and increased urban mobility are likely to drive footfalls in retail stores. These factors combined make us optimistic about a rebound in demand as we move forward. With this, I would like to hand over the call to our CFO, Mr. R. Mohan, for the update on Q2 and H1'25 results and financials. Thank you.
Thank you, Gautam, and good evening, everyone. Despite the challenging business environment, the company continues to witness a strong operating performance. First, I will give you financial highlights for Q2 FY'25. Our revenues for the quarter stood at 209 crores rupees as against rupees 189 crores in Q2 FY'24, a growth of 10% YOY. Gross profit stood at rupees 132 crores, a growth of 15% YOY with a GP margin of 63.1% for the quarter. Our EBITDA for the quarter stood at rupees 64 crores as compared to rupees 57 crores in Q2 FY'24, a growth of 12% YOY. Our EBITDA margin stood at 30.5%. Profit after tax for the quarter stood at rupees 21 crores and witnessed a growth of 3% YOY. PAT margin stood at 9.9%. Coming to the H1 FY'25 performance, revenue stood at rupees 429 crores in H1 FY'25 as against rupees 379 crores in H1 FY'24, a growth of 13% YOY. Gross profit stood at rupees 268 crores, a growth of 16% YOY, with a GP margins of 62.4% for the half year. EBITDA for H1 FY'25 stood at 136 crores as compared to rupees 121 crores in H1 FY'24, a growth of 12% YOY. Our EBITDA margin stood at 31.7%. PAT for H1 FY'25 stood at rupees 49 crores as compared to rupees 46 crores in H1 FY'24, a growth of 6% YOY. Our PAT margin stood at 11.5%. ROCE and ROE, excluding Ind AS impact as on FY'24, stood at 20.7% and 16% respectively. Cash and cash equivalents stood at rupees 238 crores as on 30 September 2024. With this, we will now open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Agarwal from Ikigai Asset Management. Please go ahead.
Yeah, hi, very good evening and thank you for the opportunity. Firstly, just a clarification, you said 50% of EBITDA conversion into cash flow going forward pre-Ind AS, is that correct?
Yes, correct. Or pre-Ind AS EBITDA into pre-Ind AS operating cash flow.
Okay, perfect. And so EBITDA is after tax, right?
No, EBITDA is before tax. It's before depreciation, interest and tax.
Yeah.
No, operating cash, pre-Ind AS operating cash flow after tax.
Yeah, that's what. So, give it.
Yeah.
I get it.
Yeah. OCF after tax. Yes, absolutely. Yeah.
Okay. Secondly, just wanted to get some sense around this entire consumer demand, right? I mean, there's a contradictory feedback across a lot of consumer products we are getting this quarter. Some, maybe urban is slowing down, rural doing better, some pockets do better than the other around India. Just in your experience, how have you seen demand flowing through for your products across India regionally, pricing-wise, new products, where is the demand shifting really? Any color on demand and competition will be really helpful.
Yeah, thanks, Rahul. So see, demand has been very slow around, and I mean, honestly, we've not seen any real improvement. In fact, July, August, we have seen decent improvement in demand. In fact, we were having a single-digit SSSG also by September first week. But unfortunately, September was a very weak month, with slight early Shraddh as well. And, the entire SSSG, what we had in the first week of September, just kind of became flat by September end. So the demand has been a little slow. As far as regions are concerned, look, our majority of our network are present in urban locations. So we have not seen a very big outlier, urban versus rural. But if I take from a geography perspective, south has been a little slower than usual. Otherwise, west, north, and east has been pretty much steady. South has been a little slow.
And what would you expect in your internal analysis going forward into next 4 months? Because it's very critical for these festival days actually to turn out better. So any sense on that?
We are working towards a 15 to 20% growth. Currently, first quarter we delivered a 16% growth. This time we have delivered a 10% growth. So on a H1 basis, we have delivered about 13% growth. So moving forward, our company aspiration is going to be that we want to achieve growth between 15 to 20%.
Got it. Thirdly, I saw an announcement about Mr. Vijay Srinivas getting appointed as the head of MBO sales. Any thoughts around this? As in, is the company really planning something big here? Because I thought that was not a focus area.
Rightly when you said our focus area is EBO, LFS and online, more towards the online stream. But when we look around, a lot of brands have been doing really well in MBO. Many of the modern trade stores, the family stores across regions have graduated and they become a lot organized. There our presence is very weak. So we see if we do selectively MBO well in these family stores, in these local family stores, right? I think there is a huge potential. So I think that business over a period of time can become a small channel. Right now we are doing about 6 crores a year, which is next to nothing. So our idea would be to build it into a decent channel in the coming years. But doing it selectively. Our idea is not to go gung-ho and go very big in MBO because there are many risks in that business like discounting. So we want to do it in a very calculated manner. I would put it that way.
So, let's say 50 crore business in like 3 years out, is that what we're doing or we're going to be...
Very difficult to estimate right now, Rahul. I think, look, right now we've just appointed a head. So probably over the next couple of quarters, we'll get a sense of a business plan, what can come out from this.
Got it. And just the background of Mr. Srinivas. So you mentioned the industry in the press release, but what was he doing previously?
He was into FMCG and he worked earlier in many FMCG companies and he has a very good experience in this MBO and distribution business. He's earlier worked in TTK and he also worked in Cafe Coffee Day as well. So he's very familiar with FMCG and general trade.
Got it. And lastly, just on the stock pledge, any update from the family side as in what's really happening around that, please?
Right now, Rahul, there's no updates. Honestly, we wanted to clear the pledge by December is what we had committed to everyone, but as of now, we don't have an update. We're working on it. The pledge is absolutely safe. There's no risk on the pledge. I would like to reconfirm that. The pledge is absolutely safe. But from a timelines perspective, I'm unable to give a guidance right now, unfortunately.
Sure. So essentially what we should expect is even that gets delayed or whatever happens, like by March, we should at least expect the pledge to go down to 0, right? There is, that much we can expect.
March, I'm unable to commit March. I'll tell you the reason why I don't want to tell March because every time I've given a timeline in the past, we've not met the timeline. So for me, giving a timeline right now is very difficult, but I can rest assure you on one thing, it's on the top priority of the family to clear at the earliest.
Okay, perfect. All right. Thank you so much for answering my questions and have a great Diwali.
Thank you. Wish you the same, Rahul. Thank you.
Thank you very much. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Thank you. The next question is from the line of Prakash Kapadia from Spark PMS. Please go ahead.
Yeah. Hi. Couple of questions from my end. Gautam, we were very hopeful of that 4 to 5% SSG. And, now if we look at some of the other consumer businesses, commentary has not been positive. So are we still, hopeful, confident of H2 being far, far better and upcoming season would get us there? What has been the volume growth in Q2? And, I think we have been alluding we'll open around 120, 125 EBOs. So how much have we opened in the first half? And, what would be the capex for that? And in case we see maybe muted demand continuing, would that continue or would you reduce the EBO expansion? Those were my questions.
Sure.
Thanks.
Sure. Thank you, Prakash. So I think, Prakash, we were very, I also just mentioned earlier that we were very optimistic in the middle of Q2. But unfortunately, September was quite a low month. And the low single-digit SSG, what we had of 2 or 3% in the beginning of September, just flattened out by the end of September. So it's unfortunate that September was weak. But look, we are very positive. I mean, look, what I've been hearing around, is that many brands are saying that this festive is going to be a good festive. So I'm very optimistic. And we are going to be looking at targeting a growth of 15 to 20% on an overall basis. And I think hopefully H2 should do better than H1. I don't see any reason why it shouldn't. And I think the mood among brands has been very positive. So I think we are working towards a growth of more than 15%. As far as ASPs, as far as SSGs are concerned, so for Q2 our SSG was 0.54%. On a volume basis, it was minus 0.6. And for H1, our SSG was 0.46%. And on a volume basis, it was minus 0.59. As far as store openings are concerned, on a net basis, we have opened about 41 stores in H1. And we have fallen short of the guidance what we have given on a net basis. Actually, what has happened in Q2, we've realized, as our product collection has increased, our average store size is around between 300 and 500. In our network of stores, there are still some stores which are very small. Some stores might be 150 square feet, 190 square feet, and those stores are not able to accommodate the range what a 300 or a 400 square feet store can take. And what we've realized that many of the customers, when we did a small research among customers, many of the customers are finding it very difficult to shop and they're organically migrating to a larger store in the same market. And because some of these smaller store leases were coming to an end, in Q2 we decided not to renew them because we didn't want to get into a future commitment in these stores again. So we have shut about 10 stores in Q2 pertaining to size. So on a net basis, we've added 41. In H2, we are targeting to open about 60 odd stores on a net basis. And on a gross basis, we are going to try adding about 80 stores. So on a net basis, we will be at around 100 stores net for the full financial year against the original guidance of 120 to 150. So we have fallen short of that. But right now, we are quite confident that we'll get to about 100 stores on a net basis by March.
Okay. And what would be the capex if you could just quantify?
See, it will be anywhere in the range of between 25 and 30 crores. But since we are generating healthy, 22, yeah, it will be around in the range of 20 to 25 crores. Since we are generating healthy operating cash flows in the line of more than 50 crores, I don't think...
I'm sorry to interrupt, sir, but can you please rejoin the question queue for a follow-up question?
So, since our operating cash flow is more than 50 crores, it is 55 crores for H1, I think capex will be well supported by the cash free OCF what we generate.
Okay. Fine. Understood.
Thank you very much. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So first question is on the LFS category. We have seen a strong growth this quarter as well on a very, very strong base of Q1, but your receivable days have also increased. And if I look at Reliance, which is 90% of your business, they are under pressure from their results. So what's happening on the LFS front, and how much of the inventory we have pushed for the festive, because receivable days have increased?
So Ankit, I think the receivable days are a little increased because we've added more number of stores in H1. And because we've added a good number of new stores, the sales on those counters would not have really reflected, but we've placed the inventory which is debtors in our books. So I think because of that, slightly inventory days would be higher. As far as festive is concerned, we have not done a lot of festive stock dumping at the LFS end. I think the kind of base stocks what we maintain at an LFS level, I think has been pretty decent, which should take care of festive. So we've not done any large number of dispatches as far as festive sales are concerned for quarter three. As far as Reliance Retail and other LFS is concerned, I think if I take an average out of Q1 and Q2, I think the performance of Reliance Retail and overall LFS, if I look at it from an H1 perspective, has been pretty decent. And we are expecting good, decent performance in H2 as well.
Sure. My second question is on your store closure. While this year you'll be closing around 35-40 stores of the smaller size, can we expect next year also some store closures to come in the same proportion? Or
well, maybe another 10, 15, maybe another 10 stores next year. But I don't see. I'll tell you what has happened. We've covered majority of the stores this year, the very small stores. It will, even if it happens next year, it'll be low single digit, maybe 4-5 stores. But it's not going to be as big as this number.
So can we expect 130-140 store addition next year on a gross basis?
Yes, absolutely. Yes, absolutely. No, in fact, I think, look, next year, I don't see too much of we don't see too much of store closures. So on a net basis, we see ourselves adding at 120 plus stores next year, for sure.
Sure. My last question is on the A&P spend. While the first half we have done, 2% spends, and you alluded that the second half could be better off as the demand comes in, and you're hopeful that the demand will come in. So can we expect the higher A&P spends in second half?
Not really, Ankit, because see, usually A&P spends are accelerated just before festive. We've kept our A&P spends in check because the overall environment is very weak. So in a very weak environment, when you spend too much on advertising, it does not really affect your performance too much. So we will be maintaining the same hygiene level of 2% spend even in H2. So marketing sales spend as a percentage of revenue will not change.
Sure. And if I can just visit one more question on gross margins. We have seen strong gross margin expansion in the quarter. Right. Is it a one-off, or we are seeing the low-cost inventory now really hit the system and we can expect this trajectory to continue?
Well, Ankit, it's a combination of two things. One is obviously the lower cost inventory. That is one reason. The other reason is that there are certain products. See, usually all our products carry the same GM. But there are some products which are slightly having a higher GM, and those products have done fairly well in Q2. And that is why you're seeing a very strong GM of 63.1%. So I think on a steady state basis, Ankit, you can expect a GM of about 61 to 62%. It will range in that bracket.
That's helpful. Thank you so much, Gautam, and happy Diwali to you and the team.
Yeah, we wish you the same, Ankit. Thank you.
Thank you very much. The next question is from the line of Devanshu Bansal from MK Global. Please go ahead.
Yes, hi, sir. Thanks for taking my question. Just a small follow-up on the previous question. Which are those products that have done well for us, Gautam? If you can just call out which have higher gross margin.
See, there are few products in the pants category, and there are some few products in the jeggings category, which has slightly higher gross margin, and because of which it is reflecting in our GM.
Understood. And any new innovations that we have done for the upcoming festive wedding season? Any interesting new launches that we have done?
See, we are continuing to strengthen our pants and jeggings category. And I think, look, some few product additions we keep doing through the year, but we have not done anything really, we've not really come up with any special range, like how we had come up with an athleisure range earlier last year. It's, there's no special range which has come out for festive, but we continue to strengthen our pants and jeggings portfolio by coming up with new colors and some new products as well.
Understood. Gautam, second, you are indicating that focus is on relatively larger stores, 350, 400 square feet. I guess just wanted to check on store productivity perspective. These stores will be having higher productivity, right? Versus the earlier smaller stores that we are closing now.
In recent times, I've definitely seen that the 300, 400 square feet stores do better. Because from a shopping experience perspective, customers just prefer shopping in a slightly larger store, because our color range and our product depth also has increased. The very small stores really are not really working very well. See, there are some stores which are continuing to do well. What we have done is we have taken a call in those stores those markets where we have a slightly bigger store and a smaller store, we have shut the smaller store. That does not mean our small store network will go away. That's not going to be the case. So wherever we feel that by shutting the smaller store, the sale will move to another store in the same cluster, we have done it on that basis. So eventually, we don't see a loss of sale by shutting these 10 stores, what we have done this quarter.
Understood. Just a small follow-up here. So that 20,000...
I'm sorry to interrupt, sir, but can you please rejoin the question queue for a follow-up question?
Sure. Yeah.
Thank you. The next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, good evening, and thanks for taking my question. Most of them have been answered. So just wanted to ask this on the soft demand environment and challenging environment for the apparel retail that you mentioned in the opening comments. Now, a segment of the market which is value fashion, whatever data we have indicates that they are doing well. So I just wanted to understand how are you concluding that it is an overall demand environment which is soft and we are not losing any share to, let's say, the other organized players, and the confidence that the festive will revive this, where is this coming from?
So Sameer, I think, we at Go Colors are operating in the mass premium range. Value retail might be doing well. But from a mass premium segment, things have been slow for quite some time. And I think from a category perspective, the mass premium category is something we've always targeted. And I think, when I speak to the other retailers and all the retailers are having a positive mindset that this time festive might be good. So that narration is probably coming from there. So we are quite optimistic that this time Diwali and post-November and Christmas and New Year's also will do a good number. So the narration on the slowdown was more from a mass premium segment. Yes, pockets of value retail are definitely doing well. Our customer is the mass premium customer, so a value retail customer will not really eat into our sales as such.
Just a follow-up here, Gautam. So one...
Sorry to interrupt, sir, but can you please rejoin the question queue?
Ma'am, it's a follow-up on the same questions, ma'am.
Okay, sir, go ahead.
Sir Gautam, I just wanted to understand this. So mass premium is doing slow. First of all, how do we conclude this? That it's the overall market which is a problem and not only some of, Go Fashion or some other retailers. And second is that are we sure that the consumers are not downtrading to the more value retailers kind of a thing?
See, in retail, Sameer, there is a premium segment, there is a mass premium segment, and there is a value segment, right? And there is a customer for each of these three segments. When I evaluate the other brands in the industry, everyone has been complaining about a little bit of slowdown. Of course, there are some exceptions there, and that's always going to be the case. But when I speak to most retailers, the sentiment and the commentary is very similar. So I'm somewhere deriving that conclusion from what little bit of research and the chat what I've been having with the other folks.
Got it. And downtrading question?
See, on the downtrading question, for the kind of product we have, we are priced at the bottom of the pyramid. So I don't see value retail eating into our share. The customer who wears the kind of product we give, they will definitely come back to a Go Colors. or any other brand in the mass premium segment if they have a similar product offering.
Sorry, you mentioned that you cater to the bottom of the pyramid. Didn't get that. Sorry.
The bottom of the pyramid as far as mass premium is concerned. See, for the kind of product offering we have in terms of specs, our pricing is the lowest, is one of the lowest. So I think for the kind of value offering what we are giving, I don't think value retail should eat into our team. I don't see that happening.
Got it, Gautam. Thanks. I'll come back for any follow-up.
Sure. Thank you, Samir.
Thank you very much. The next question is from the line of Gaurav Jogani from JM Financial. Please go ahead.
Yeah. Thank you for taking my question. My question was regards to the inventory bit. You alluded in your opening remarks something on the why the inventory was down. Didn't really catch it. If you can just repeat it, if you don't mind.
No. See, actually, Gaurav, historically, we were carrying very high inventory in the books in terms of number of days. So over a period of time, we have rationalized inventory. So we had about, if I'm not wrong, we had about 120 days or something of inventory earlier, and we have brought it down to 97 days. In Q1, we had 87 days of inventory, and now we have about 97 days. Obviously, inventory days have slightly gone up from Q1 because we are entering the festive season, so we're carrying slightly higher inventory. On a steady state basis, we see ourselves carrying inventory anywhere between 90 and 95 days. So compared to earlier quarters and years, we've rationalized our inventory a lot.
Sure. Thank you. And the next question is with regards to the overall, again, the demand bit only, but it's more on the regional side. I think the data that suggests, your most of the sales is coming from the southern part of India. So are you seeing, and the store opening is also in that region itself. So any particular reason of opening more stores in the southern part of India and not the other parts of India? Anything that you can, allude on this front?
See, our expansion strategy has not really too much to do with how a region is particularly doing in a particular period, right? See, for us, if a city has a potential where we can have multiple stores and the city from a consumption perspective is good, we open in that city, regardless if that region is weak or not. So I think our city selection has nothing to do with current trends. We go on the basis of size of city and then we decide.
So no, the question was because, we have been seeing that you said that the northwest and the east part has been relatively stable versus the south, which has been a bit slower. And hence, wouldn't it make more prudent sense that the demand conditions were more steady to open more stores there?
No, we are trying to. Definitely, north and east is definitely one of our focus areas. And, because the base is weak, because the base is low there, our growth rates also have been very encouraging. So we are opening in north and east. But at the same time, when we are getting very good store options and opportunities in the south, I think it's a good time to take it. Because when demand picks up, then we'll end up having a good location also in these markets.
Sure, Gautam. Thanks. That's all from me.
Thank you, Gaurav.
Thank you very much. The next question is from the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Hi, thank you for the opportunity. The first question is on ASP decline. What is leading to that ASP decline on first half?
No, actually, Prerna, there was a correction. I mentioned in my opening remarks. In the investor presentation, we actually, by mistake, showed only the Q2's ASP. The blended ASP for H1 is 750. So there's actually a 1% increase in ASP on a YOY basis.
Okay, I missed that. I joined in a little late. Okay.
No problem.
And sorry, I missed the number again.
759. It's 759.
Okay, 759. Okay. Now that makes sense now because I was worried about
We ended up noticing last minute. So sorry, apologies for the mistake.
No problem. I also missed the opening remarks. So second question is on where is the demand, better in terms of categories and where are we faring well? You mentioned jeggings and pants, but what about the core category of ethnic wear and how do you compare it with your western wear portfolio?
No, see, our core has been doing very well. So we have not seen any real decline or anything in our core category. core categories like leggings and churidars has been our historical product and is even continuing to do now. Just as a company, because the sales over a period of time have started shifting more towards the specialty bottom like pants and jeggings. Our focus also is more on those kind of product segments. But as such, our other categories like leggings and churidar, we've not seen any as such decline.
Okay. One more question, if I may. Just wanted to understand on how is the SSG, what is the kind of SSG that you're building in for this 15%-20% growth that you are looking in? I mean, what are your expectations with respect to and generally we see some demand contraction also after festive season. So how could this be?
See, without being very over aspirational, I think we are working towards the 15-20% number with a medium, low to mid single digit SSG. So I think we are working towards that. So we are hopeful that we'll be able to achieve that in the coming quarters.
Okay. Thank you, Gautam. All the best.
Thank you, Prerna.
Thank you very much. The next question is on the line of Saurabh Mundal from RK Advisory. Please go ahead.
So my first question is on your application. I've seen that in Play Store and the rating is very low. I think it's around 2-star, and most of the problems is that they have a problem with logging in or making accounts. So can you tell me why is that?
No, Saurabh. Actually, what happened? We've not really launched our application officially yet. We had actually launched that application more from an internal training perspective, but because it was on Play Store, many customers downloaded as well. So we've actually not officially launched it yet. Over a period of next few months, we are going to be launching our app store.
Oh, okay. That's answered the question. Now, the second question is, how do you do the omni-channel sales exactly? Like, when the customer visits the store and then they did not find the right fit or right color, and you take the number or email and you do messaging or give them an email or
typically what happens, Saurabh, so I'll first start with the online part. In the online aspect, when a customer places an order, the closest store in that region will deliver the product. So our aspiration is okay, if a customer is placing an order, then do a local delivery through using your network, and can we deliver it within 24 to 48 hours is our target. That is as far as website is concerned. As far as store is concerned, since we carry so much of inventory at a store level, the likelihood of a customer not finding their color and size is usually little less. But in that cases, sometimes we try converting that customer into an online customer. So then and there we have a tablet, we convert that customer into an online customer, and then the closest store in that particular region will dispatch. So these kind of omni-channel initiatives we are doing currently.
Oh, okay. My third question is, our products are competitively priced and widely appealing, including in smaller cities across various regions. Given this, could you clarify where there isn't a greater focus on expanding beyond your existing cluster and region? I know you are opening stores beyond your cluster, but why not leave cluster and go beyond the cities where you are not present?
No, we are going now. In fact, we are actually doing that now. We're trying to go beyond our clusters and open stores in new cities, and that is something which is one of our key focus areas. And we will see a lot of that come in the coming quarters. But I think even if we do that, I don't think our ratio of our top 10 cities and the tier 2, tier 3, I don't think that ratio really changes. But definitely a strong focus is definitely there in cities where we are not present.
Okay, that answers the question. I was actually saying that because we are kind of taking our marketing initiative through store opening. That's why I'm saying that. But that answers my question. Thank you.
Yeah, thank you so much.
Thank you very much. The next question is from the line of Abhishek Budolia from Narnolia Financial Services Limited. Please go ahead.
Hi, good evening, sir. I just wanted to ask that your FY'24 LFS case was 182 crores and your debtor was 79 CR. So your debtor days come about 159 days. So why is it so high when we take only LFS days for debtors?
See, see, the thing is, the debtors which is in our books is actually inventory on the shop floor. The unsold inventory is because of accounting standards is debtors in our books. So that's why the number of days has always ranged between 150 to 155 days. So on an overall company revenue basis, our debtor days is between 37 and 40 days. But on a store level, it is high because the unsold inventory there is debtors in our books, because the LFS partner will pay us only after they've sold it. It's on SOR basis.
Okay, and you're sitting with around 220 crore of cash and you make around 50 CR of cash half yearly. So what's really stopping you from rapidly opening stores? I mean, next year also you're given target of 120 gross stores only, which has been constant for about multiple quarters. And even your cash flow generation has declined from H1 to H1. So can you elaborate on the cash management strategy?
See, H1 to H1, the cash flow looked declined because the last year was the year when we had reduced a lot of working capital and inventory. So last year, effectively the cash flow was a lot stronger. This year, we've not really reduced too much of inventory or working capital. So whatever EBITDA we have generated is converted into operating cash flow. So one of the reasons why H1 this year versus last year H1 OCF might look a little different is because last year only we had reduced working capital. As far as opening more stores rapidly is concerned, see, real estate sometimes can be very tricky. So we don't want to be in a hurry and open wrong stores. So that's why, see, usually I've told in the past also that if we evaluate 1,000 locations, we end up opening 120 to 150 stores because we have a 12% hit rate. So we're trying to increase the number of stores we evaluate, and we formed a good busy team. So we're trying to improve that larger number of 1,000 stores and end up opening more. But in real estate, we have to be very careful. If we do a very strong and fast expansion, we can sometimes end up opening wrong stores as well. So we want to maintain a quality hygiene as far as store expansion is concerned.
Thank you very much. The next question is from the line of Akhil Parekh from PNK Securities. Please go ahead.
Hi, Gautam. I just have one question from a competitive landscape perspective. If I look at tier 1 cities, stores in tier 1 cities, right? So have we done some kind of study in terms of what percentage of Zudio stores are there in close vicinity to Go Colors? Because a year back, even kind of DMart acknowledged that their apparel segment is getting impacted to some extent because of increased competition and because of players like Zudio. And we continue to see the footfalls in Zudio remain very strong, even during last 3 months, basically. So that is one, the competitive intensity in the tier 1 cities. I think tier 2 and beyond, we have almost 35 to 40% of the stores. Nishu, which operates in those geographies, has given an update that their sales have grown by 40% during first few weeks of the festive season. So is there some kind of impact which probably we are not acknowledging in these two geographies, basically, which is tier 1 and tier 2 and beyond?
We are largely more top 10 cities. In majority of our network is there more in tier 1 and top 10 cities. So for us, our experience has been very consistent, honestly. I mean, our presence in rural is not very high. So we've not seen a very difference in experience between rural and urban, honestly. As far as opening locations are concerned, look, Zudio has been doing well, and there are many other retailers who are also doing well. So we follow all such retailers.
My question is the competitive intensity because of Zudio is impacting our sales in tier 1 cities? And is the competitive intensity because of Nishu is impacting our sales in tier 2 and beyond other cities?
Okay, sorry, I misunderstood your question. Zudio or any other large format store will not impact our sales. We are a very specialized bottom wear brand with so many color options and product options. So for us, competition would be really someone else who's doing bottom wear in a dedicated manner. So that will be an apples to apples comparison. So right now we don't see any of the large format store out there eating into our share.
And same holds true for Meesho as well, you're saying?
See, honestly, online players honestly are not competition for us because online is a completely different ballgame. So for us, like I mentioned, a dedicated brand in bottom wear selling online or offline would be real competition. Meesho is still again a marketplace. So the same example for LFS and Meesho go hand in hand from that perspective.
Okay, that's all from me. Thank you, sir.
Yeah, thank you.
Thank you very much. As there are no further questions, I would now like to hand the conference over to the management for closing comments. Thank you, and over to you.
I'd like to thank everyone for being part of the call. We hope we've answered your questions. If you need more information, please feel free to contact Mr. Dilen Dhruva from SGA, our investor relation advisors. Thank you. Wish you everyone a very happy Diwali and happy festival. Thank you all.
On behalf of Go Fashion India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.